Welcome to the Minds Capital Podcast, the show devoted to the growing world of independent sponsors and entrepreneurial private equity. I'm Will Smith, here with my partners in Minds Capital, Nicholas James and Max Lummis. Guys, welcome home. You were just here in Northern Virginia visiting me. We had our annual GP mini retreat last week, which was a blast. So thank you for coming. Any thoughts on our time together?
Oh, thank you for hosting us, Will. Northern Virginia is amazing. I have, of course, been to DC many times before, but I had never really spent time in Virginia or Northern Virginia like that. And you showed us around Alexandria and your hometown. It was amazing. You knew all the best place to go, of course, and had a blast. And also thank you to our LPs in the area who showed up to our LP dinner on the Thursday night.
I second that, Will. Yeah, thank you so much. Great event. Beautiful. It's beautiful up there. And we had some good food. We had some good strategy sessions. And of course, as you mentioned, Nicholas, we got to meet with some of our LPs, which is always fun, and to get to know them a bit better. A lot of folks sometimes these days, you only get to meet virtually. So it's always great to meet people in real life.
Yeah, it was a lot of fun at the happy hour, and great to show you guys around Old Town Alexandria. Old Town is often overshadowed by the district itself, which is where everybody goes when they visit. You guys had spent a lot of time in DC, so you humored me in coming over to Alexandria, but I think you thought it was worthwhile. So recommended to the audience, Alexandria, Virginia. Great. Well, today's interview is with Jim Tapp of Tico Partners. Max, any takeaways on our conversation with Jim?
Yeah, there are several. I think Jim's deal that he talks about in the SaaS space, he was an early SaaS independent sponsor investor. And what a home run he hit, going from essentially almost a distressed buy, not distressed, but the seller was very motivated to sell. And he got a great deal on the front end, and then they grew it all the way up to $100 million exit. So that's got to be one of the bigger, better spreads in this space. So that's always really exciting to hear about what's possible. And, Jim had good nuggets and kind of pulled back the curtain a little bit on what it's like to deal with, governance within deals related to this everything from the CEO of the company to his investors. And I think a good takeaway is for sponsors to think about sort of their anchor investors and control type investors that are interested in their deal. You're not just taking their money. In some cases, you're taking terms and giving up some control with taking on their investment. And Jim talks about, I think he had obviously a very favorable outcome with this deal that he walks us through. But it's important to think about those terms on the front end of your deal, I think, particularly for sponsors with maybe less experience who haven't been the full cycle on a deal before. Jim mentions that specifically there was, the fund that invested in his deal. This deal was a sort of a late fund investment for them. They needed a win. They grabbed a bit more control on this deal, had a few more strings on the deal, and they were also sort of more pressuring to exit the deal and put forth some pressure in that regard. So I think it's not just the capital that you're taking on a partner, and they can have different control requirements from voting rights to being able to push you to exit. They can sometimes also have thoughts or control over you being able to fire and hire important employees like CEOs, which he goes into. So there's a lot of considerations when you're taking on a capital partner, and I think Jim highlights that. I think it worked out well for him, but you could only imagine how contentious a relationship could become when you, as a sponsor, are giving up some of those key control rights in a deal.
Yeah, to piggyback on that, I thought it was interesting how he mentioned there had been pressure from one of the investors to exit. This, of course, doesn't sound that extraordinary, but it made me think a little bit that investor relationships are not static or monolithic. in fact, the dynamics of your relationship, like every other relationship, will change over the course of a 5 or 6 year hold. And so you might be dealing with a patient investor if they're early in their fund, or perhaps if they're otherwise underperforming a little bit, and so they're spending more of their attention elsewhere, and you're kind of the kid that goes along and doesn't need so much attention, right? But on the other side, they might be impatient if they're late in the fund, if they would rather have a bird in the hand versus two in the bush at any given point, or importantly, if they're fundraising or about to fundraise, and your deal might help trigger more success in the fundraising endeavor. You might be dealing with a friendly/passive investor if things are well performing and they have a lot of dry powder. They could be a pain in the ass if you're bottlenecking them, right? And so it's important to be cognizant of this. And especially, I would say, for any fund is always a fundraiser. They're always thinking about, when are we raising next? What has to happen before we get to that? And if they're actively fundraising on the other side, that might also mean they have no time for you. So there's this dynamic going on at all times. They might be in between fundraisers and they all of a sudden are auditing their whole portfolio and really getting in deep. And then they're fundraising and they have less time for you, especially if you're well performing. It's good for you if their portfolio has maybe had another exit or two that is good, so they're in the water. It's bad for you if everything else is underperforming and you're the only one man standing. They might rely a lot on you. And so what I guess I'm trying to say is that the investor vibe, it's hard to gauge the lifetime of the relationship up front. And the vibe as you go is a lagging indicator of performance, their portfolio construct, their fundraising timeline, their bank account, right? And just general politics on their side. And so be upfront when you're fundraising, and especially from institutional players, so that you understand where their heads are, where their timeline is. And I think the clearest indicator is, where are you in your current fund? Are we the first deal or the last deal? And understand that, and then ask your closest AI to tell you what that means downstream for you.
I'll just call out in the interview a couple details. First, Max, you already touched on it. We get a up-close look at what it's like to be a sponsor with a CEO that you are having conflict with. The strategic direction that one of Jim's CEOs wanted to take the business, the personality differences caused strife that lasted for a while. Again, to your both of your points about control, Jim didn't have the control to make the decision to replace or change that CEO, so he had to really build an argument over time to convince the rest of the board that a change was needed. And so we really kind of hear that saga, and it was a painful lesson, I think, for Jim. It all worked out. As you saw in the title, if you clicked on this episode and listened to it, Nicholas was very excited, justifiably, about this title of 50% carry on a 50x MOIC. What a story! What a find of a business, and what they built, and riding the SaaS wave. Kind of the timing was just absolutely perfect. So it's a really, like, a once in a career type outcome. Really exciting. So of course we spend a lot of time on that deal. Well, before we get to the interview, a reminder: Minds Capital invests equity into independent sponsor-led acquisitions. Our check size ranges from 1 to 3 million, and we average a commitment a month. So if you are a sponsor raising equity for a platform acquisition, submit your deal to us at mindscapital.co. Or if you're interested in investing in Minds Capital as an LP, there's also a pre-registration form on our website. So if you're an accredited investor, fill that out to be kept in the loop on future raises. Again, the URL is mindscapital.co. And here is the Mindscast interview with Jim Tapp of Tico Partners. Enjoy. Welcome to the Minds Capital Podcast, your connection to the growing world of independent sponsors and entrepreneurial private equity. We are your hosts, Will Smith and Nicholas James. Joining us today is Jim Tapp. a private equity veteran based in Atlanta. Jim is a West Point grad who, after a decade as a business broker in the 90s, raised and managed private equity funds before transitioning to the independent sponsor model. He has notched some big wins, including a 50-bagger in software, early SaaS days. We're going to hear all about that deal. But his proudest roll-up is at home, where he's raised 5 kids and is currently awaiting his 8th grandchild. Congratulations, most of all, on that, Jim. His latest venture, Tico Partners, brings the family into the office as he teams up with 2 of his sons to hunt for their next deal. Jim Tapp, welcome to the Minds Capital podcast.
I will. Hey, Nicholas. Good to see you guys.
Jim, to start us off, tell that story of the Newport Beach business owner you were exposed to way back when that inspired you to start on your own entrepreneurial journey.
Sure. So when I left the military, a lot of guys went to Fortune 500 companies. I went to Mobil Oil Corporation and was in their commercial division that sold engineering services and industrial products, and moved around a good bit. Ended up, like a lot of guys that are in large companies, I think at the time Mobil may have been by revenue the largest company in the country, and so you feel pretty good about yourself that you're part of that company, and you feel like you're on track. Well, they moved me to California, where my wife and I bought a house that we couldn't afford based on what I was making at the time. But I was managing a distribution network, and these distributors largely are guys in coveralls and oil guys. And I don't want to say I look down on them. I don't look down on anybody, but I never really realized kind of what they had or what they did until I met this guy in California and got to know his business really well. And even then, after knowing his business pretty well, I really didn't know the scope of how successful he'd been in life in general, running this oil jobber at the time. And so he invited me to here's my wife and I struggling with 2 kids and barely, paying our mortgage, I think, at the point in California, as you might imagine, and invited me to his Christmas party out in Newport Beach. And the party was on his yacht, which was probably worth 3 or 4 of my houses at the time. And he just was a humble guy, a good guy, had a team around him that was really nice, but was enormously successful. And I realized that, that in the 90s, this is the early 90s, you're traveling around, you're doing the corporate thing, you're going to the meetings, everybody's trying to move up the corporate ladder. And here's this guy that just was blocking and tackling and making a ton of money, had a great family life, and it really changed things dramatically for me. And it wasn't that long after that, I got myself moved back with Mobil to Atlanta. And very shortly after that, said, I got to go do something else, for myself. So I credit him with that. I never talked to him again after I left California. I probably should send him a note or send his family a note or something, because he was really the motivation to get me started.
Well, I so love that story, Jim. But I've actually heard many stories like it, that pattern, which kind of looks like the fancy pants. Oftentimes I've heard it from private equity people. They're at the closing table and, they're at their private equity fund or firm, and they see which direction all the money in the room is flowing. And it's to the blue collar founder across the table. Right. And it's like, wait, if we all think we're so smart, why is he the one getting paid?
Why is he doing it? So I've had a number of them since then, but now I love it. I mean, I just love the entrepreneur that's made that investment and took those risks and made that money. It's fabulous. It's what keeps me going every day. Yeah. Those kind of guys.
It really reminds me of the Rich Dad, Poor Dad book as well.
It does.
You're talking about an expensive mortgage, and here you have a business owner on the other side.
Yeah.
Just out of the blue inspires you like that.
Yeah. And again, I am positive he had some difficult times. He started the company. Obviously, I'm sure he had hard times. California, up and down economy over the years. And I think by the time I met him, he'd probably been 20 years in the business. So, yeah. And a good guy on top of it. Good family guy, good guy. It's great. It's just great. Wonderful. Yeah.
Well, Jim, we're not going to have time to cover your whole career, but so let's zero in on
Sure.
the origin of your career as an independent sponsor. You had been doing fund-based private equity. You pivot into becoming a sponsor. Give us a bit of that origin story, and then we want to hear about the software deal.
Yeah, sure. So as we were talking before, I had started an M&A business. That's how I left Mobil and started an M&A business. And there was a logical progression back in the day, that was about 30 years ago, to move from M&A or stay in M&A permanently, or move from an M&A to private equity. Private equity was becoming more and more accepted. There were more funds being developed, et cetera. So I sat down and wrote a business plan, started looking for partners to start a fund, and ran into my partner at KT Capital, which is where I spent the majority of my career, about 20 years doing KT Capital. And I ran into him. He wanted to buy a company. He had just left. He had some experience with TriVest. He was a CFO and a CEO for a short period of time with TriVest. So he had private equity experience. I didn't have that. And so we hit it off and we decided to raise a fund. We found I think he introduced us to a third partner that was a former NFL guy. We raised some capital for a fund, KT Capital, and we started investing right into the recession in 08, 09, and 10. Had some challenges through that, but came out really well and returned a lot of money to the investors in spite of it being a recessionary environment. And met a lot of, and it was mostly NFL players because our third partner was an NFL guy. He wanted to go in a different direction. My partner at KT and I wanted to go in the direction of maintaining strictly private equity, private equity environment. He wanted to do some other stuff, and has been quite successful. But he decided that moment that we were still seeing a lot of opportunities, things to buy. Obviously, after the recession, there were some entrepreneurs that they rebuilt a little bit and they wanted to get out. And so we were seeing a lot of deals, and we wanted to stay in the deal business. So rather than raise another fund, we decided to go with the independent sponsor route. And I don't think there's very many people doing that. I mean, guys would come out of business school and say, I want to go operate something. There was a lot of that. There was some of that going on at the time, but they were just operating one company. But we wanted to be true to the private equity model, but do it as independent sponsors. And there's a ton,
but why as sponsors, Jim? Why not raise a fund to do it?
Yeah, I mean, I think that there's a couple of answers to that question. One is staffing up and hiring and fulfilling all the regulatory obligations, and making sure that you're complying with government rules and regulations around a fund. It takes people. You're using up some of the capital there, time. I didn't want to be pushing paper and making sure we were in compliance all the time with things. So it just wasn't that appealing to me. Our third partner was a broker dealer, and I could see where he was spending a lot of his time, and the kind of people he had to have around him to be able to do that sort of stuff. So that wasn't appealing to me. I wanted to be with the entrepreneurial sellers, because we're we're in the $1 to $5 million EBITDA market. Our sweet spot is really around $3 million of EBITDA to start. $3-4 million. Those are entrepreneurs, guys that you need to connect with, that you need to be close to. And I felt like if I had a big fund, big fund back then for us might have been 50, 100 million, right? If I had a big fund, I would lose that contact with those guys, because you have to do so many deals. You got to put the money to work. You got to overcome your, 2 and 20. And it just was not that appealing to me. I don't know how else to describe it. I am one of those guys that kind of goes the road less traveled sometimes, and maybe that was it. I don't know, but I just like doing deals, and I liked staying to, 4 or 5 platforms at a time. That was all we could really handle, 4 or 5, maybe 6 platforms while we were spinning off one at a time. And I love that, because I knew every CEO. I knew all the key managers within the deals, the strengths and weakness of them. And then I started, it was fulfilling. It was probably the military background, but it was fulfilling to bring guys along. You get a really great VP of sales that someday is going to be a good CEO, try to give them more responsibility, get them presenting to the board, doing things like, I love that. It was just very enjoyable. And I think I just always felt like I would lose a lot of that if I did a fund.
This is about 10 years ago, right, Jim? My question here, how clean is the transition out of the fund model and into the independent sponsor model? Or to which extent, as differently, are there kind of tentacles or longevity to the fund that you need to still wind down as you transition?
Yeah,
to
that's a great question. We really, up until the day we sold our last portfolio company, which was a very successful deal, we were managing the fund and managing the investors and, reporting and doing all the things you have to do. And so we sold our last portfolio company before I jumped into the independent sponsor model. But fortunately, we had deals queued up and things like that we had been looked. So there was still, obviously, there's paperwork and tax returns and questions and, things you have to answer along the way for probably 1 to 2 years after the last portfolio company is gone. I would say that lasted about 2 years, but we were getting into the independent sponsored deals while that was winding down. But it was wound down within 2 years. You have to go back to the archives from time to time. A guy's getting an audit, or a guy didn't do a tax return right, or something that they want some information from you, but it wasn't burdensome at that point. A little more today is a little different. I still have 2 portfolio companies at KT that I manage. I'm the chair of one of them, and one of them is a 6-company roll up. So I'm, my sons aren't in those deals with me. They help me, from time to time, but I've kept them kind of over here in this new, new venture that we have. So I'll probably be working on those 2 deals for another 2 years. So and then that would, lead me into another 2 years on, beyond the sale of the last deal there. So they do have, they do tag along with you for a while. And a fund would be longer typically, but fortunately we sold the last portfolio company as we got into the independent sponsor model.
Jim, when you were talking about why you were drawn to the independent sponsor model, I was waiting to hear you say the word flexibility, which is so often what sponsors cite as one of why they like the model so much. And I'm not saying that's not one of your reasons, but
no, it is. It's 100%.
But this idea of being close to the entrepreneur, I think that's a first time I've heard that characterization, which I really like.
Or the CEO, even if the entrepreneur is retiring and you're bringing in a CEO to run it or elevating somebody, it's the same. I just want to be close to them. But I will say, below that reason, flexibility, clearly big one. And I think the other thing is your LPs. Like if you have an LP that's difficult in one deal, and you didn't know that LP was going to be difficult, or they put demands on you and you needed the capital at the time, you can go to you don't have to go to the same LPs every time. It's nice. Sure. And you can also go to LPs that can add value. So if I'm in a software deal, I want software heavy LPs so that I can pick the phone up and call a guy and say, hey, I need a developer for this. Can you help me? Same, we're in manufacturing. I want to bring guys in that know manufacturing. So
yeah,
that's really great. It's to be able to do that.
In your experience, what benefits do you get from strategic investors like that in the independent sponsor model? What have you seen when you bring in a software or healthcare investor?
Oh gosh, I think
whatever it is.
Yeah, I think that's a great question. We're in a recycling business, and one of the things that we identified in that it's a recycling manufacturing. They manufacture these big shredders and cutters and balers and things. Really great company. I'm very excited about it. We've been in it about 2 years, and done an add-on, getting ready to do our second add-on there. It's wonderful, a wonderful business. But one of the things we recognized was the sales team. This is going to be I'm going to go on a little bit here, Nicholas, to answer your question, but I think it's worth answering. The sales team was not making cold calls, new business calls, et cetera. They had a core group of business that they were selling to over and over again. Guys would build a new, MRF, they call them, or a new recycling center, or whatever it is. And they weren't selling. Well, we had just sold a company called DSD, which was in the automotive space. And the president of that company and the CFO of that company made a ton of money, and they became good friends of ours. And they had capital from the sale that we had just had. That was another really big sale for us. We didn't talk much about that in previous calls, but they were able to make money in this DSD company, or grow this DSD company from, we bought it 30 million. They had a backlog of about 100 million for the subsequent year in which we sold it. And they were able to build that by putting into place a system of you sell, you project manage. So when they brought in project managers to hand off from the salesman to the project manager, the salesman then went on to the next sale. What was happening prior to that was the salesman was selling and then project managing, and he'd get out of the sales business for a long period of time. It's an age-old problem with a lot of people, but sometimes people just don't really identify it. Well, these guys did, and that change took them from 30 million to 100 million. We were friends with the guys that, I became friends with the two young guys, and I'm in a deal with them right now. I'm in 2 deals with them right now, and I kind of help them along because they're young guys and haven't been around private equity, but they had a lot of capital from this deal, and they came in as strong investors into this recycling business with me. And one's on the board, one's an observer on the board. They came in and helped build the sales organization for this company for us. So that the long answer to your question, Nicholas, and right now we're starting to get the fruits in this recycling business of guys that are selling all the time, making cold calls. We had a win this week in an area in which we're not in at all in the business. It's going to open up a whole new area of business for us from a guy that was making cold calls that hadn't made cold calls before. So it's been wonderful.
But there's a spectrum for an investor from being passive to active. And then there's kind of a cross spectrum, if you will, from being no value add to high value add. And so how do you know and identify this on the front end? Because an investor can often say that, yeah, we have done a software deal before and it might even have gone well.
Mm-hmm.
It doesn't mean they'll actually contribute. So what should be your expectations as a GP when you bring on so-called smart money?
Yeah.
Do you expect them to be proactively involved, or is it more that their expertise is available if I give them a call?
It's both. I have control over that, obviously, because I'm putting the boards together. I'm managing the boards. I'm strategically in the companies with the CEOs. So it's kind of all of the above. So I think in software, for example, we're going to get into talking about that deal, but that CEO, he's a friend of mine. He's an investor in our current software company. I have a small software company now, and he's on the board, and he's helped us tremendously with our sales strategy, with, kind of managing we have a president that's taking that business over, kind of mentoring him. So I call him in to ask him to do that. And I think we were struggling with marketing there. And so he wasn't really doing much around marketing, but he's a marketing expert. So I pick the phone up and I call him and I say, hey, I need you to really kind of help us get this marketing plan together so that we can get the leads going for our software sales, et cetera. And he's happy to do it. We'll try to pay them from time to time, whether we're paying them a board fee or we'll pay them a consultant fee, something like that. We're happy to do that. But I have other investors in that deal. The developers from our software deal put some money into this as well. I'll pick the phone up occasionally and say, here's a question around developers. If we're looking to hire somebody, what do we have to pay them? Where should we find them, et cetera? And then that's the end of that conversation. I don't really need them to do ongoing work for me there. So I think we run the spectrum of very active board members as LPs. I guess you're not really technically calling him an LP if he's a very active board member, but very active. Guys we can pick the phone up and call and get help from, and guys that are very passive and we just need to report to on a regular basis. So we have a combination of all of that.
Jim, let's turn our attention now to that incredible software deal. Was that your first deal when you formally became an independent sponsor?
I think it was. We may have had another small deal that we made an investment in there, but it was the first one we really worked hard on. Really got after.
Well, this was early SaaS days before SaaS was hot, which is a big part of that return.
Yep. Yes, it was.
But people will be nostalgic and be kicking themselves for all the opportunities that existed back then that nobody saw. But you did.
Yeah, exactly.
So let's hear about it.
Well, I mean, you also have to attribute a lot of this to luck and, timing of luck. So I don't act like I was, some brilliant, identified this diamond in the rough. It didn't, I was focused on EBITDA. Like that was my life, right? EBITDA. What's this deal doing EBITDA? Well, we could sell it for you, Mr. Entrepreneur, for 6 times, and is it verifiable in a QV, et cetera. So we found a deal. It was doing $2 million of EBITDA. And unfortunately, he was an older guy, but died unexpectedly. He was a healthy, what people thought was a healthy guy, and he died. And so he left his wife, who was in her, I think she was 80 probably when I met her, and with this business, and it was like 5 guys, but it had been around for 15, 18 years. It originally was kind of a Lotus spreadsheet, I think, and then they moved it to a Delphi. I think it's Delphi platform, like an unusable platform today. And so that was written on a Delphi platform. Had one developer that was really this quirky guy that had moved himself unbeknownst to the widow to North Carolina and said, I'm just going to work remotely. This is before anybody worked remotely. That drove her crazy. And had 2 sales guys that were just carved up the country in half. Anyway, they were successful, making $2 million EBITDA, and she was going to close it. She was introduced to us, my partner KT and I, and we flew down there to meet her and said, don't close this. It's got $2 million EBITDA. And she said, and we said, what would it take for you not to close it? And she said, I don't know and she was wealthy at the time. The software company had made them plenty of wealth, and they protected it and invested it carefully. So she was great. So she didn't care that she was going to close it down. And, she said, if you gave me $2 million for it, I'd do it. And so my partner and I said, well, let us go talk. Let's go talk in the other room. And of course,
Yeah,
I'm sitting here, everything I'm seeing
give us 30 seconds. To make this
everything I'm
decision.
seeing is, well, I'm not letting this thing go for less than 7 times. That was what we were seeing at the time. And we walked out of the room. We said, you have a deal, and we'll close it fast as we can. I think we closed it in maybe less than 45 days. And we brought in the 2 million.
Jim, what was the business?
What was it? Oh, I'm sorry. Yeah. It was a roofing estimating software. So, commercial roofing. So, any commercial building. So it was a, good target market. I mean, and we were not hitting any of it, as you might imagine, but, big opportunity to grow the business. So that we did see that. We were, I saw, look, they're in this much of the market, the market is this big, they're in that much. So we saw that as an opportunity. I really liked the sales guys. They were great guys. There's a couple of other people in the business. There was like a ops guy that just did everything. He was a good guy, liked him a lot. And so we liked a lot of the people when we met him. I think there was only 6 or 8 people, but, so they were commercial roofing. A company was called the Estimating Edge, still out there today. I don't know if I'm sure they still use the brand, but, they, commercial roofing on this Delphi platform, and it was, not SaaS. And so, and they also couldn't turn it off if somebody didn't pay their maintenance. So they had customers in there 10 years, hadn't paid their maintenance, still using the full software. I mean, it was, can you imagine that today? So, I guess there's still some of that today. So, we not only, so it's $2 million of EBITDA, and that was the attraction for me. That was always the fallback. It has millions of dollars of EBITDA. We're going to use some of that EBITDA to build the business, but we're not going to drive it to 0 and, or go negative to build the next, Excel or Microsoft or something. What we're going to do is my fallback position was always multiple of EBITDA, 100%. And so
what you mean by that, Jim, is you weren't going to try to do some sort of VC style Silicon Valley play and try to take over the world.
100%.
You were going to iterate on an LBO style acquisition and make it better and grow it, but not too grand here in the plan.
Exactly. 100%. And that's, I think I've talked before about this. We got crossed up with we've had 4 CEOs in that deal. And so that's unusual for us, but we hit the right guy on the last guy, fortunately for us. But we had 4 CEOs. And the one before the right guy, that's what he wanted to do. And that wasn't us at all. And he didn't read us at all. And I think he thought he could control the board, and he couldn't, And so we didn't want to do that because it was too risky. There's so many of those deals at that time. There was a lot of success, guys making billions of dollars potentially, but there was also, for every one of those, there was a bunch that went bust. And so our fallback always was, I've got $2 million EBITDA. I can sell for that for 10 million bucks all day long. And I bought it for two. And so that was our fallback. We were in the money from day one. So we did two things there. We brought a Mezz lender. We raised the equity to buy it, but we also brought a Mezz lender in to give us working capital so that we didn't have to tap too hard into the $2 million EBITDA. And so we brought a Mezz lender in. We were putting a lot of our own equity in. We raised regular equity at regular carry. And then my partner and I were doing a big slug of it. And guys that knew us, we were telling them about the deal and they were clamoring to get in, put more in. And so you asked, there was a really great piece of this that worked out for us. And that is, we had a huge percentage of the equity at a 50% carry after we returned the capital. And so the way we got there was, we bought a company for $2 million. It was probably worth 10, certainly worth 8. And so we were already in the money. We were letting guys in to take our equity, my partner and my equity, which was probably smart because we were looking ahead and saying, well, I need to keep some dry powder. And we didn't have a lot at the time. And so, so guys agreed to it, and happily. I mean, very, very happily. I mean, I think they might've regretted it when we gave them their checks in the end, but they got a lot of, made a lot of money, even with a 50%, carry. So, so that was the story. So we brought a Mezz guy in, for a little bit of working capital. And
Jim, just to, pick at the structure a little bit, help me understand, with a multiple like that, a 1x multiple, could you not have done it with all leverage and just a little bit of equity from you guys, personal equity, and kept 100%?
We could have, yes, we could have, but I mean, we wanted to use we probably would have broke covenants. It wasn't a perfect, it's a Mezz size deal, right? And the Mezz guys are kind of focused on certain covenants. We wanted to use $1 million of the EBITDA to build the business. We probably would have broken covenants. Didn't want to do that. We just didn't want to do that. And we figured, look, later on, we certainly can, raise more debt if we want to. We can raise debt to do dividends. We can take out the Mezz, and we ended up doing that. We took the Mezz out, but they, of course, still had their, they had some warrants or something at the time. So, we could have. I mean, today, if I did that deal, we're putting in, I don't know. I still might do it all equity. I really don't. I mean, we can get into this, but I mean, I like the equity dividend model. I like it a lot because our deals are Mezz reliant right now still. And unless something happens in the marketplace on the debt, for smaller deals, we're Mezz reliant still. And I just don't like that much. I love my Mezz partner. So I don't want to be, going negative on them here, but I like let's do equity and a dividend model of some kind. And then we do add-ons. We'll bring in some debt, we'll do it out of our line. We'll do it out of cash, whatever we can. So anyway, that's what we did back here. People didn't understand it. Actually, the Mezz groups didn't understand what we were buying. They were worried about it, so we found a guy that wanted to put a little capital in. So we did leverage it some. And, it also proved.
And on the equity side, it sounds like it was split a little bit. So you had your own tranche, and then you had 1 or 2 or 3 classes of equity holders.
Actually, we were all in the same class, but it was all side letters with the carry. So it was all same class of stock, but it was different carries, for different.
Right, but stretching up to 50% for certain investors who had been clamoring to get in.
That's right. Yeah. That's correct. Yeah. And I didn't feel bad about that. I'm a guy, look, I have big conscience, guilt, whatever you want to call it. So we weren't trying to rip anybody off. It was really pretty simple math for me. It's like, well, I keep dry powder for the next deal. I'm going to give you basically what is already something already worth 4 times what we paid for it.
Yeah.
And I needed something in return. And then, real estate guys were doing that too. I mean, it's not unheard of, but it was good for us. Worked out, very well.
Well, yeah, exactly. You're effectively pricing in the multiple arbitrage
Yeah.
at the closing table. And so you're saying this is worth 4 or 5 times and you're buying in at this value. So that's why your effective ownership is going to be lower, hence the higher carry is how to reverse engineer that.
Yeah, I'd like
we
to
see
think that I thought of
every now and
I'd
then.
like to think that I thought of that idea, but I didn't. My partner did. I have to give him due credit. My partner thought of that idea. So it worked out well.
And just you said downstream when you paid back the capital and there were good returns on this deal. Despite the good returns, was there any reaction to it? Then?
I mean, everybody always is going to say, "I can't believe you're getting X, on my money," but they're happy. They're happy they're getting what they're getting. So and there weren't, we didn't have, because it was a smaller deal, we didn't have a ton of guys. So guys we knew pretty well. Yeah.
So you closed the deal and you rolled through 4 CEOs before the 4th one was the right one. Tell us about the journey of the...
Yeah. So, I mean, the first CEO was really, it actually was a guy that introduced the business to us, and he was a placeholder, and he knew he was a placeholder, not a software guy. So that one was easy to move on. We just had a conversation with him and said, look, we're just flat. We're not growing. We're not going where we want to go. And he had some other things he wanted to do. So we hired a guy that came out of large software enterprise. Good guy, smart, and I think was taking it in the right direction, but he misstepped on this Delphi conversion. So we had this Delphi platform, and he was with a large software company, so he was used to offshoring stuff. That was I don't actually know how much offshoring is going on code writing now. Well, of course, a lot of it might be going to, to AI, but guys, large companies were offshoring a lot of software, and so he offshored the rewriting of the software. We put a ton of money into it, and we got a really bad results out of the rewrite. We were just starting to understand that. We didn't, because we weren't in the day-to-day of the business and we're not software guys. We were just starting to understand that was wasted money and we were going to have to restart. His family, he had 2 kids, grown kids, that moved to Washington State. And I think one of them was getting married. He wanted to be near them. So he elected to move. We didn't have to move on him, but I think he sensed that we were not going to be that happy about his decision to offshore and spend a ton of money and it being kind of worthless. And we uncovered that sort of after the fact. And I don't know how much of that had to do with him moving on, but I think he probably would have moved on, if not voluntarily, but
did you have to rewrite it yet again?
100%. So then we go into the CEO number 3. So we're kind of desperate for a CEO, right? Because this guy puts in 2 weeks, says I'm gone, and goes to Washington State. And so we're kind of back to dealing with sort of the team that we purchased and not capable of building and growing this thing. And also that now there's no leader here. And so we went on a mad, frantic search for a guy that I would say this, if people are listening about being an independent sponsor, getting into this for the first time, I didn't trust my instincts on the guy that we hired. My partner liked him. One of the board members liked him a lot. I did not connect with him, and it unfortunately, but I agreed to hire him and give him a shot because he had, good chops on the software side. And so we hired him, and he became a really difficult guy you can imagine. So here I am, my fallback position is EBITDA, right? So then we hire a guy that's been in Silicon Valley. His fallback position is raise $10 million, hire 12 developers, hire a sales team, have a cash burn. I think he started talking cash burn with his strategy. And, I was like about to lose it. And so it was a it was a power struggle, really a weird power struggle, because I'm a chair of the board, and but he did have the ear of one of the board members who also we had given, it was a Mezz guy, and we had given veto authority over firing of CEOs and selling the company. It was a big mistake. That was a giant mistake. And so I spent a year interacting with the CEO almost every day and taking the fallout from employees of the stuff he was doing in the company and pushing back on him. He'd run out to California and he's like, I got guys that'll put $6 million in tomorrow for 50% of this. And I'm like, well, that's not even worth what it's worth. It's not even what it's worth right now. And I think at one point he made a presentation. He said, we have to hire 20 developers, and we had one at the time. And, so we were in a lot of conflict, and I was right, by the way. I don't say that often. There's a lot of times I'm happy to be the guy. I've been married 39 years. So I'm happy to be the guy to say I was wrong. You got to, I'm happy to. So I'm not afraid to do that, but I was right. And he is not the right fit for this deal. And so it took me a year though, to convince the veto power guy that I could move on him. But in the interim, what I did, and this is a guy I really do want to have you, I'm going to say his name because I think I could do that. A guy named Adam Oakes. Adam was the final CEO. And he was introduced to us by a company. You guys know Tech CXO. Do you know those guys? There's a company here in Atlanta, I think it's Atlanta based, called Tech CXO, that made the name for themselves by providing outsourced CFOs for deals. Obviously, that's something very useful to me. So I met a guy there at Tech CXO, and we had used him before for some CFOs on deals. And he said, hey, I got a really good sales guy that's now part of our team. He ran a sales organization for a software company, and I said, well, introduce me. So I met this guy, Adam Oakes. Liked him right away. He was an ex-Army guy, was a helicopter pilot. And so he's like a helicopter pilot, and no offense to fighter jet pilots, but a helicopter pilot in the Army is like a fighter jet pilot, which is really makes a pretty good entrepreneur, but without the bravado of a big, because they're flying a piece of equipment that at any minute is going to fall out of the sky. And so they're very humble guys. And so Adam was just a wonderful, humble guy, but super smart, super talented, knew everything about sales. So we brought him in as a sales consultant to build our sales organization, because that's what we thought we needed most. And we did. And so he did that. He did a really wonderful job as a consultant. And as I'm working with him and I'm working with the CEO, I'm like, this guy, this is night and day. This guy could drive this company for us like crazy. He's never been a CEO before, but it's a little tiny company. He's managed way more people than he would manage here. And he knows software, he knows SaaS, he knows. And so I went right to the board and I said, I want to hire this guy and remove this guy. They said, no. They said, no, we're not going to let you do it. So I kept building the case against the CEO. And ultimately, I had a notebook. I wasn't keeping things on, I was keeping them on the computer, but also still keeping notebooks at the time, which no longer is a practice for most people, but had a notebook full of like interactions with him every day. And it was just, I was, awake at night thinking about what this guy was doing to our company. And it was not great. And so finally, after a period of time, convinced the board, hey, it was the right thing to do. But then they made me bring in another consultant, an older guy, to CEO it while he watched my guy, Adam, for a period of time. But after about 3 months, the consultant's like, I'm doing no good here. The guy's Adam. And so it took me a long time to get there. I don't know if I'd have that patience again today to do it, but then Adam took over, and, the rest is kind of a really great story there.
So you told us a little bit about the boardroom conversation around firing a CEO, but mechanically, how does it go down? Was that a surprise to him? Exactly how did you confront him? How quickly do you cut the tie with someone who's a key person? And how do you tell the team and customers? Like, how does that actually go down? Because it's a dramatic move, even if you have
It is. And it's not something you like to do. I don't relish it. But in this case, it was better for the company to remove him. So how did it happen? I mean, I always, whenever we're making a change somewhere, you always have to assess okay, what are the unforeseen, what are the unforeseen challenges to this? What customers am I going to lose? Who could he take with him? That's key. And so you go through that whole assessment, and you have to not let your emotion say, I'm just getting rid of them, because that's the temptation. We were in big conflict. And so it's like, I'm just getting rid of them. We're really very tough to do. If you can really damage your business if you do it that way. So in this case, we didn't lose anything. I knew that. I mean, I wanted to fire him a year earlier, so I knew what customers he was embedded with, which was literally none. He didn't really know our product. He really had and I don't want to I don't want to disparage him, because he probably was successful somewhere else, but he just wasn't a fit. That's the best way I'd describe it. So what do we go through? We have those conversations of what customers can he take with him? Are there any of our key employees that we want? Can he damage us in any way if he's really upset with us? And the answer to all those questions was no. We got to move. We were preparing for that. I had Adam already in there doing all the sales organization, so they were all answering to him already. Everybody else in the organization was gravitating towards Adam because he was a reasonable guy, and nobody was really bonding with the other guy who was spending all his time in California or wherever talking up a story that really wasn't a story. So we didn't lose much there. I've had other CEOs that we've had to remove that were very difficult. How did it go down? I did it personally. I mean, I think it's important that if somebody at that level, that I don't have Adam do it or anyone else. I did it. I went down and we had a dinner, and I told him, kind of that we were going in another direction. He
must not have been surprised.
No, he was very surprised. He was very surprised because I brought the two guys from the board that were his big supporters, and he didn't know they were going to okay this. And so he, I'm at dinner. It was before dinner, and I said, we're just going to go in another direction. And so he looks over to the Mezz guy that was part of the board, older guy that had been around forever, and he's like, I thought we were in love, kind of thing. And he was like, no, I agree with Jim. We're making a move. And so
did he stay for the meal?
He started to, and then I said, I don't think that's a good idea. we had a drink, and then we were having a meal, but my intention was to have him go. We were in a private room, and I said, look, I don't think it's a good idea if you stay. We'll talk on Monday morning or whatever it was. So we were.
So there was a little bit of a period where he stayed for transition purposes. Then
we didn't want him to. I didn't. The last straw was they were missing a number, and he told the entire company, if we don't close these deals in the next 3 days, you guys are all fired. And he just went into a tirade in the company, and it all came back to me. I mean, people, and I don't like doing this. Like, I don't like guys if somebody comes to me in the company, I send them back to the CEO. I'm like, look, you can't call me.
You can't insert yourself in the operations. I got a
CEO. Right? I'm undermining.
That undermines the CEO.
Yeah,
exactly.
Yeah. So I'm not in the habit of doing that, but the phone starts ringing with guys saying, look, I'm going to leave, and I'm going to leave. And they probably got together and did it, and I, of course, already was ready to make that move. So we made the move, and it was not.
And it happened pretty quickly, but not instantly.
But that when you get those calls, it does help you present a case to your Mezz guy who was resisting.
Yes.
So it does serve that purpose. And just by the way, Jim, as you reflect on your learnings here, you've already said that giving the veto power for both company sale and CEO replacement was a mistake. Anything else on how on this whole experience that were clear lessons?
Wow, I have to really think about that. I think, we took the good and the bad with the Mezz thing, right? So give them veto power. And I didn't, one of the things I didn't do is understand where the Mezz was with their fund. This was their last company in their fund, and they had some, through the recession, earlier in the same fund, they had some not great successes. And so they really needed this to be a big success. So they had a lot riding on this. I didn't know that. I should have diligenced them a little bit more than I did. And I probably would do that today. We've honed in, we've locked in on a couple of Mezz guys that we use today, we know and trust and are really value add guys. So I should have diligenced them a little bit more. I didn't. So that was a mistake. I should have the biggest thing was I should have just trusted my instincts. It's not, 2020 hindsight. It was, I interviewed him and there was just some things weren't right. And I just ignored them because some other guys liked them, and I should have spoken up and I didn't. And then I always felt like that was a little bit of a weakness, but it worked out. I don't know if I would have ended up with Adam, running that thing without this step. So, but I do regret not like saying my piece on it ahead of time.
Yeah. Well, that's also just easy to self-criticize, because when everybody else is confident in a decision and you have some doubts, it can, I mean, we're always struggling with, is my gut telling me something here really important, or am I just not being smart?
Yeah.
It's that tension exists in many decisions.
These are smart guys. I mean, my partner was a smart guy. He's a lawyer and an accountant. And, the Mezz guy was a lawyer and was a big time lawyer and big political guy, been around forever. Smart guys.
I wonder if it sounds like there were two big problems with this relationship. First was culturally, doesn't sound like he was maybe the most effective leader, but also that he had an entirely different strategy for this business than you did. You were coming at this from a PE posture. He was coming at this from a VC posture. Very different ways you build those businesses, obviously. Is that something that you could have gotten in advance, learned in advance?
We knew it, and he knew, we knew it, and he knew it, and he knew. I made it clear to him that PE wins here. The PE strategy wins. Our fallback position is 6 times EBITDA. That's our fallback position. We hope we're getting 10 times revenue, but our fallback position is 6 times EBITDA. He knew that, but then his character came through, and that is, I'm going to win this guy over on the board, and I'm going to win this guy over on the board, and I'm going to overrule him, even though he's the chair of the board. And he started doing that. Clear. I watched it happen. I mean, in our meetings, in our communications, he would have side conversations I knew with guys, and so I saw it happening. But we were very, very clear from the very beginning, and he was like, "Yeah, no, I understand. That's where we are. I'm not gonna propose that we spend all your EBITDA or that we bring in outside capital. And if we do, it's going to be so favorable. There's no way you're going to be able to refuse it." And I think that's where he was. I think he thought he was going to go, bring $50 million to us, for 20% of the company, and it wasn't. There was no market for it at the time. It just wasn't. So I think he underestimated what he could do and bring, and the value he brought to the table. That's all. But as I said, probably a guy that I haven't followed him, probably a guy that's been successful with somebody with the right, the right people around him, but not a fit for us. There's a whole lot of things I would have liked to done different in my life, now that I can look back on it.
Well, you and me and everybody else too, Jim. So that's okay.
Exactly. Yeah.
Great. Well, we only have you for a few more minutes, Jim, but we want to ask you a couple more questions. Let's wrap the story and hear about the exit, and then we'll start closing us out.
Yeah. So we bought the company for $2 million. We changed the platform. We added a marketing person. We went through the CEOs. We built out a sales organization. We built out, marketing so that we were getting qualified leads often. We were closing deals. We were doing seminars. We just changed our look and logos and did all the things you should do to build a good company, and then ended up with a good CEO. And the end, the story is we sold it for around $100 million. It was a company that Thoma Bravo wanted for one of their portfolio companies. It was a really good fit for them strategically. And it went smoothly. They were great to deal with. I don't know if they've since resold that platform. I think maybe they have. But this was a small piece of it got it added. I think at the time we were still only we were on track to do maybe $5 million EBITDA, 4.5 to 5 million. It wasn't a huge deal. And I think they were putting on something that was 25 million. So it was a small piece. Adam stayed with them for a couple of years, and then he retired from there. And I think they were very successful with it. The company's still very successful. It's a leader in the industry. We converted it to SaaS pricing. We really didn't convert it to a full SaaS, program, a resident where it was still a resident program. You still had to have it on your on-prem. And, but it was SaaS pricing. And so people could get out of that once a year, but we would take all their data if they did. And so that was the beauty of it. That was a big change, right? Before, guys had all their data no matter what, but the data we resided in the cloud after we converted it. And so if somebody didn't want to stay with us, they didn't have their data. And you want the data because you want to be able to pull down the roofs you're doing everywhere, because you're redoing them or et cetera. So anyway, great success, and really kind of, launched us and made a lot of people a lot of money, and we're still investing with those people today. It's wonderful. Yeah.
That's great. And of course, in the background to all this is the rise of SaaS as maybe the hottest category. So you also benefited from market demand for businesses just like this. I mean, the timing could not have been better.
It was very fortunate. And we knew that it was a hard call. I'll finish with this there. It was a hard call because to go to SaaS pricing, you reduce your revenues dramatically. You reduce your revenue dramatically because you're now recognizing that revenue over a longer period of time, and it just goes down. And you have to plan for that. You got to model it. I mean, so we did that, and everybody was prepared for it. It didn't go decline as far as we thought because we were gaining new customers quickly. But suddenly, then you get to year 2 and year 3, and your revenue just starts taking off. As you're building the customer. So it was there's a reason why SaaS was very valuable. It just was predictable and it grew fast if your company was growing and you had a good product. So yeah.
Operative word there was. Is this where we start talking about Claude?
Yeah, well, I mean, I'm not the expert there.
Let's save that for another day. But we just got you now here for one more segment, Jim, and it is actually your sons that are the AI guys, as I recall.
They are,
but you're partnering with them, and so let's just hear a little bit about doing that and what that looks like.
Yeah, so their backgrounds are a little different than me because they have the benefit of me kind of growing up trying to figure out how to do this, right? So my older son went to Wake Forest. I sort of forced him to go. I didn't force him, encouraged him to go towards accounting because he was going to college during the recession. And I was anticipating, well, what jobs are going to be available when you leave? Certainly accounting jobs. So he got his 5th year as a CPA at Wake Forest, and then went to work for KPMG in accounting. Home Depot was his client. Learned a lot there, and then decided to move over into deal services at EY. And so he went to EY and was doing transaction services with them, with diligence, QVs, legal diligence, et cetera. Learned just a ton. Like, obviously those guys were doing deal after deal after deal, and he was on a lot of big deals. And a lot of his clients were big private equity here mostly in Atlanta. And so he did that, and he stepped out for 2 years and did a private equity deal with a guy that was doing retail roll-ups. Did that for a couple of years to get a taste of that, and then went back to EY, asked him to come back. He went back to EY and was going towards partner at EY, but really wasn't feeling fulfilled there. And he knew what I was doing, and he's always kind of wanted to do it. So I'm going to go backwards a little bit because the younger son, I have 3 sons, but the middle son joined me first because he was going to grad school. So he was undergrad, then he went to work at Regions Bank in commercial lending, and he knew he had to go to grad school. So he went to Columbia, and the 6 months prior to going to Columbia, he came to me and said, "Can I work with you?" And so he worked with me. I paid him through Columbia. We actually did a deal while he was at Columbia. He did a lot of the work. And then the older, and so he joined, he's been with me 2 years. And then the older son came over about a year ago now. And so I have a CPA son that has done a ton of private equity diligence deals, just really talented. And then I have a commercial lending son that's got a great MBA, and their skill sets are just we're all very complementary. We're all different guys, very complementary. Yeah.
What are the pros and cons of working with family members and sons in this case?
Well, I mean, there's the pros are the pros and the cons. The pros are you can say anything to them, and kind of get away with it. They're not at risk of joining the competitive firm or something. The cons are you got to live with them privately when you're kind of saying things you maybe don't want to say. Like I had a hard conversation with one of them yesterday over some things he was saying to me about a portfolio company. And I said, look, I know it's just you talking to me like this, but I'm taking it personal. I'm taking it very personal. So you got to kind of, it's easy for them to be more personal with me than they would be with somebody that wasn't their dad. Right. And vice versa. So you have to be careful about that. But so far we worked really well together. You get a little nervous. It's like, well, I got a family and grandkids and all this with a lot of eggs in one basket. You start getting nervous about that a little bit, but it's fine. They're talented guys. If something imploded with this, they're going to land on their feet. No problem at all. So,
and Jim, just to understand what you said there, it's too easy to deliver criticism back and forth so people can be a little harsher with each other.
Yes, it 100% is. It 100% is. Yeah. And so I would say this is when your dad is giving you criticism, you take it a little more personally. So I have to be careful with that, and when the kids are giving the dad criticism, I'm going to take it personally, so you just have to be a little more sensitive to it. That's all. And maybe it's a good lesson in general. I'm a plain speaking guy. They'll tell you that. But it's a good lesson in general. You should be a little more sensitive to people today, especially, 15 years ago, you could just hammer on people pretty hard. Today, not so much.
Those were the days.
But you have a personal relationship here that is, of course, transcends the importance of any work function at all. And so working with someone, it can augment that relationship, but it could also detract from it under certain circumstances. So how do you assess that risk and navigate that?
Well, we do. We're a pretty tight family, as you might imagine. Everybody lives around here, so there's a lot of us, and we get together pretty often. So we're very careful not to talk shop, amongst everybody, because then you're excluding some family members, and we're also. I think I'm careful not to talk too much about my sons in particular to my wife. And I hope my sons are careful about their wives and significant others. We want to keep a little bit of a firewall there. And, so, but so far so good. I mean, my daughter-in-law still talks to me, so that's good. And,
but you have also 3 other kids, I believe. Do they have FOMO, fear of missing out here, or do they feel excluded in any way?
Well, I'll go through them. One's a pediatrician, so she's a stay-at-home mom right now, but she's a pediatrician, so this is not her area of expertise, and she doesn't have any problem there. And the other's an artist, and so she's a marketer too. She does a full-time marketing job. Probably could help us, but that's not. I don't want to bring that egg into the basket, and I don't think she wants to join there. And then the last one's in college. This is a really interesting one. It's another son. He's a junior, be a senior. Once he finishes May, but he's going to work for A&M in New York on their diligence team that is doing AI. And he's a finance and MIS major, but he's doing this minor at UGA on on AI. And so he's moving into this area that it's going to be cutting edge, I think. That can lead us into a little bit of AI talk. But my goal is always for all of these kids is anybody who wants to join, go do something, go build a skill that warrants it. Don't be the son that's going to just glom on. So I'm not hiring the third son out of college. He's got to go build a skill, but he's building the right skill. I didn't move him in that direction. He just has a high interest in it. So I think he's going to get a great experience. I hope he gets an offer from them after his internship in New York this summer and drives through, some AI diligence with these guys, so anyway, then no, they're all fine. They're all good. And we all take pretty good care of each other here. So it's nobody's, if we were talking about it all the time at the family get-togethers, that would not be good. I can tell you that. Yeah.
Hey, one final question from me. Does private equity get easier with time? Time in the game, that is.
I don't think if you're doing it right, it's very hard. I mean, in my opinion, it's a hard business. You get better at it. I mean, I think that's the better answer. I don't think it gets any easier. I was still awake 2 hours during the night last night thinking about a deal that I have and some challenges I have in a deal. So that doesn't ever go away. It's always hard. It's always hard, but you get better at it. So I don't know if that's really fully answering your question.
Do returns reflect that you get better at it?
Yes, I think so. I will say it does. I'll tell you where it does get easier. You mentioned this, Will, earlier. Why don't you just leverage it? That was our attitude with our deals for a long time. It's like, let's leverage it. Well, the Mezz will do 4x, or maybe we can get them to do 4.5x and reduce that to 4x in 12 months and 3.5x. And you never get there. And so I learned the lesson. You could not make me over leverage a deal ever, because it's the path to ruin. It's 100% the path to ruin. Now you have good partnerships, and guys will accrue interest if you start struggling and breaking covenants, and they don't want to foreclose or take over a deal. But you start accumulating a ton of interest, you can't get return for your guys. So I will never over leverage a deal. I talked about this earlier. I love this model of bringing a lot of equity and dividending the preferred return potentially, so that you don't, once you're getting out of a deal, you don't have a preferred return hurdle because you've already paid it. I like that model, and using debt where it's appropriate. So I've learned that lesson. Don't over leverage. Don't do it. And it's just a path to ruin, in my opinion, unless it goes really well. I mean, sure, if something goes from 20 million in sales to 100 million in sales, you could care less that you 4 times leveraged it in the beginning, but that's not how they don't all go like that. Of course, all the Sims tell you they're going to go like that, but they never do. Yeah.
Spoken as the former broker himself.
Yeah, I know. I put a lot of hockey sticks on Sims. I can tell you, I sure did.
Jim, what a fun conversation. Thanks for doing such a good deep dive. But I feel like that deal certainly warranted it. That's a pretty epic one.
Yeah, it was great.
And it's a moment in time deal too, because it was right during the SaaS kind of cresting of the wave.
It was. I look forward to come back, because we're in a software deal now. I needed to come back, and we need this. I need that 10 times revenue. I need some 10 times revenue deals. That's what we need to go.
Well, I can't let you go. Well, with that comment, what are you seeing in terms of how are you thinking about the software space given Claude and everything we're seeing? Yeah,
I mean, I think if you have this is, I'm a big All In fan. You guys probably listen to the All In guys, but if I listen to them, I've heard it a few times on there. The story is, well, guys can use Claude, right? Or they can use an AI platform to build their software internally, but who's got the risk of that software? Yep. So we have a software that has like a potential HIPAA risk and all kinds of risks associated with it in our software company. Well, who takes that risk? We did just lose a customer that said, we're going to use AI for this. I'm like, well, okay. Well, who's at risk for your data breach now? you are the company, you know? So we have a team of guys that are constantly working on security and data breaches and things like that. And we're really well protected on our software, but you start using AI, you're not going to have that. So I think that's an area these guys at All In will say, well, there's nobody to hold accountable if you have a data breach because some young guy built an AI model that took the place of a piece of software. So I think that's the first thing. Yeah.
So does that make you a buyer of software companies, given that there's probably been an overcorrection?
I know, I'll tell you, I'm still not an expert in software. I just haven't done I'm an engineer, so I feel pretty good about complicated distribution and feel pretty good about manufacturing. That's kind of my background. I mean, I've been in a software company and I still am not great at it. So I'll look for them opportunistically. I'd like to add some stuff to our software company if I could find the right thing to add, but I'm not looking for them because I can't compete. I'm an EBITDA driven guy, and you still can't get a software deal for $2 million of EBITDA for $10 million. You can't. It's guys are paying for it. And that's not me. So, but people should be. And I understand there's a lot of dry powder again. You know, Thoma Bravo is a great example. Those guys, if they want something, they'll pay for it. I mean, they're like, hey, if this fits us, we got to go get it. And so there are guys that are out there going after stuff, but you got to have the right little niche for people to go after it.
Jim Tapp, thanks for joining us on the Minds Capital podcast.
Thanks, Will. Thanks, Nicholas. It's great meeting you guys. You're great guys. You're great at this. And I'll leave with this quick story. I've never done anything like this before. I've never promoted myself at all before, but Nicholas did such a good job when I met him of extracting information out of me. And I'm like, okay, this is like the Joe Rogan here of private equity podcast. So I appreciate you guys a lot, what you're doing. I enjoy the show. I do listen. I am a listener. Like, the boys are listeners, and I hope one day you'll have those guys on to they'll have a different side to the story. Sure. One day maybe you do a follow-up.
That'll be a great follow-up episode. And thank you so much for joining. And also for the three of you, please keep Minds Capital in mind when you have your next.
We will. We're looking hard at a few deals right now. So we'll make sure we reach out once we get a little further along. But appreciate it, guys. It's really, really a pleasure to meet you both. Yeah.
Thank you, Jim.
Yeah, thank you.
Hope you enjoyed that interview. For more like it, subscribe to the Minds Capital podcast wherever you listen to podcasts. You can also watch us on YouTube. Also check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. We invest equity in independent sponsored deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about future fundraises. See you in the next episode.